Important estate tax planning issues. My name is Fudd, and I'll be your presenter today.
No, actually, you will not be the presenter today. I will be the presenter today.
Oh, I would like to be the presenter.
No, I need you to go and draft a couple of slats and a qualified personal residence trust while I give this presentation for these very nice, attentive people.
Gosh darn it, that's no fun for me. Okay, see you.
Well, that's about as good as this presentation is going to get. It is 11 a.m. on Saturday, and you plainly have nothing better to do. So we're going to talk about hot topics and best strategies for estate tax planning. My name is Alan Gassman, and you can blame me for this presentation and the lack of quality thereof. At noon, in 59 minutes, I'll be playing a video that I recorded last night with one of my best friends, Marty Shankman, about the human aspect of estate planning. So if you are human, then I suggest this. But if you're a dummy, maybe not so much. Marty was going to speak for 30 minutes, and after an hour, we decided to cut it into two halves. So I'll be playing the first half today at noon, and then the second half in a week at noon, as adjusted for daylight savings time if Congress changes its mind on daylight savings time. As always, you can ask me questions by going to the question panel, and you can click the upside down pyramid and type in your question. This presentation is intended for both laymen and tax lawyers and CPAs and financial advisors. For those of you who are tax lawyers, the word layman means somebody who is not in our profession. That is just a new word for your vocabulary. When we're done with the presentation, no matter how mediocre it is, I will post it to our YouTube channel, and you'll be able to watch it there whether you like it or not, and then you can listen to it on your phone while you drive, but please don't watch it while you drive, except at red lights if your phone tells you when the light will be green. Okay, Saturday, April 16th, we're taking off. We're going to go find eggs somewhere. Saturday, April 23rd, estate tax planning for the wealthy, what you need to know. That will be no better than this presentation, but we'll cover some different areas. And the 30th, dynamic planning for professionals and their entities. That's a really good one because the puppet will dance and also sing. Support the tax section of the Florida Bar by attending this presentation April 27th, hot topics and best strategies for estate tax planning, what I didn't have time to say today. All right, now on the agenda item of hot topics, I have 4 hot topics that came out in the Thursday report. The Thursday report comes out, believe it or not, on Thursdays. Usually it's every other Thursday. So I always enjoy when people say, I read your Thursday report every week. Okay, it doesn't come out every week. We're lucky to get it out every other Thursday. But here's what we have in the Thursday report. Jay Adkinson, who is a well-respected, and I certainly like and respect him, lawyer, wrote an article in Forbes about a charging order case. And in the charging order case, the debtor got a judgment against him, and the court reached into the LLC and gave the money to the creditor. Now, with a charging order, the creditor is not supposed to be able to get anything until the LLC makes a distribution. And Jay felt that this case may be the beginning of the end for charging order protection. Well, we read the case, we read the appellate briefs, and that's really not what happened. What happened here was that the debtor borrowed money from Wells Fargo using the LLC's assets as collateral after the charging order went on. and the debtor's partner, who owned 40% of the LLC, got distributions, and the LLC operating agreement said all distributions are to be pro rata. So the judge said, no, it doesn't work that way. Now, interestingly enough, the creditor was Sarah Lee. Remember that song, Everybody Doesn't Like Something, but nobody doesn't like Sarah Lee. Well, Sarah Lee got paid a lot of donuts out of the LLC because of that. And our write-up is in the Thursday report, which you can obtain. Now, secondly, our second article, which is probably more interesting here, centers on this letter dated March 8, 2022, sent to Janet Yellen. And notice it doesn't say, hi, Janet, or good morning, Janet. It says, Dear Secretary Yellen. For those of you who write letters and emails, that's how we used to write letters and emails. But anyway, what it says is, I heard that taxpayers are setting up irrevocable trusts which are outside of their estates for estate tax purposes. And then when that taxpayer dies, not only do we not tax the trust, but those trusts are reporting a stepped up income tax basis. And that seems like double dipping, that you don't get estate tax and you don't get capital gains tax on those assets. And he says here, while the IRS announced it would no longer issue private letter rulings on this issue, it has not followed up with regulations. Now, the good news is that some of us, however many few we are, believe that you should get a step up on the death of the grantor of a trust who is considered to be the owner of the trust assets for income tax purposes. And thanks to the writings of Jonathan Blottmacher and Professor Mitchell Gans and Howard Zaritsky, there's just as much support, in my opinion, for the step up in basis as there is for no step up. Now, a lot of people criticize me for taking that position, but I think that the position of the taxpayer to get a step up is just as strong as the position of the commissioner. But if you're going to die and get a step up, you need to go ahead and die pretty soon, because it's looking more and more like the IRS will eventually come out with a regulation saying, hey, Jose, no step up, in which event, when you take the step up, you'll have to disclose on a tax return that you're taking a position contrary to the IRS's position. So stay tuned for that. But I do get, you know, I'm going to say the word amazed when I go to a major tax conference and 3 or 4 speakers say, and of course there is no step up. Because what I say, and of course you will be sued for malpractice if you don't offer your client the ability to report a step up. Now, CPAs are very concerned about preparer liability. The solution there is that the client gives the CPA an indemnity letter, and the CPA does what's best for the client, not what's best for the CPA firm. Okay, and we have a white paper on that I'll be glad to share if you would like to see it. Here's another nice recent situation where things are getting so good that they may not be so good anymore. We have private letter ruling 2022060008. By the way, the IRS issues private letter rulings. The average cost, I think, is about $23,000 now. They used to be free for many years. And if you have a tax strategy that you want to follow, you can write a letter to the IRS. Your lawyer writes the letter with a proposed answer, sends it to the IRS in triplicate with computer disks and the whole bit. And then a lawyer from the IRS calls your lawyer and says, yeah, we'll do this ruling, or no, we won't. Well, in this ruling, this is a very nice situation. Somebody had an irrevocable trust, and they wanted to give a beneficiary the ability to appoint the trust assets in a way that would cause a new income tax basis on the death of the power holder. And Ed Morrow, who is probably the #1 writer in the country on getting a stepped up basis from an irrevocable trust, wrote a beautiful commentary in Lineberg's estate planning newsletter. If you don't subscribe to the Lineberg estate planning newsletter, I strongly recommend that you just turn off your video right now, go to Lineberg, Leimberg Information Services, and sign up for a free 60-day trial and print everything on the website. And then on day 59, cancel. You'll have so much great information. But in any event, this private letter ruling gives you the roadmap for the ability to go to court and say, hey, I set this trust up for my children and my great-grandchildren, and it's all going great, but I forgot Uncle Mort. Uncle Mort, he's such a great guy. We would like to give him the ability to redirect the trust assets among my descendants because he's so wise. And also, it would be nice if he could also direct the assets to creditors of his estate. And then, on his death, all the assets will get a new income tax basis equal to fair market value. And they'll be considered as owned by him for estate tax purposes, but he's well under 12 million in net worth, even when combined with the assets of this trust. So someone went to the IRS and said, can I do this? And if I do, will it hurt the generation skipping aspects of this trust, which will never be subject to estate tax at the level of my children? And in the IRS, instead of saying, are you kidding? This is too good to be true. Or can you really do this? Are you really doing this? They said, no, this works well. So, of course, there's more to the story. You can read the private letter ruling. You can read Ed's letter on it. But this is becoming so public and so well known that you can expect that it is a technique that will not be around a while. So if you have an irrevocable trust and you want to get a step up and you have an elderly person or a person with a short life expectancy, this one is a no-brainer. It's so broad, though. It's so broad. If you read the statute, you could just say, I give the next person to die at that nursing home down the street the right to appoint trust assets to creditors of her estate, and I'm not going to even tell her about it because she has dementia, and then get that step up on death. Now, that's extreme. I don't recommend it, but that's where this is going. It's a really good thing. Another hot topic in the estate tax meets charitable planning arena is the IRS's approach to what we call the estate administration exception and avoiding what we call the self-dealing rules. When you take a promissory note and you give it to a charity, and the example is, I die with $100 million business, and I say, I give the $100 million business to my family foundation, but my children could go ahead and buy that $100 million business from my estate for a $100 million note, and then that note could go into the foundation, so there would be no estate tax, and then my children would own the $100 million business, and they would just pay at 2% interest per year for 25 years. It will balloon in 25 years. So there's no estate tax. The children have a $100 million business and they owe a note. And what's that note worth? What would you pay me for a note from my children, who no one would trust, right? Knowing that I raised them and seeing all these webinars, what a goofball I am. These children owe $100 million to a charity. Now, if the charity is a private foundation, then you have the self-dealing rules, and they are relatives of the person who died. So it used to be said that in situations like this, it's fine, and it may still be fine. But it used to be that the IRS said you could wrap that note in an LLC and give the 99% non-voting member interest in the LLC to a charity in a similar situation. They've recently said they're not going to rule on that. So just on April 2nd, the IRS updated their website on the estate administration exception. I haven't given any listener on this talk what you need to know in this area other than to point it out. The Heckerling Institute 2 weeks ago had a very good presentation on self-dealing. The IRS is not going to be allowing people to be as charitable as they were, so we'll have to be careful in our approaches. Now, here's another thing that happened recently on Hot Topics, and that is, believe it or not, the IRS doesn't like you to use an outdated appraisal or to put assets into a grantor retained annuity trust when you're really fibbing with your appraisal. So what happened here? Well, the donor who put assets into a grantor retained annuity trust in exchange for the right to receive a stream of payments used what the IRS said was, and I quote, an outdated appraisal did not take into account all facts and circumstances of a pending merger. So what happened? He knew that he was going to merge into a public company and that this $5 million company was going to be worth $15 million, for example. So he found an appraiser to ignore the proposed merger, and the appraiser valued it at $5 million. He put it in the grantor retained annuity trust in exchange for the right to receive $1 million a year for 5 years. So it was a very small gift. I put $5 million in, I get $1 million a year for 5 years out. Very small gift. What's left in the trust after the 5th year is out of my estate for estate tax purposes. That's the grantor retained annuity trust. And what's almost magic about the grantor retained annuity trust is that if you put an undervalued asset in there, you say, oh, I think it's worth 5. I'm putting it in. Here's my appraisal. Oh, it turned out it's worth 10. I'm so surprised. I thought it was worth 5. The appraisal said 5. Oh, it says it's worth 10. Well, I don't owe a gift tax to the United States government. Instead, I just have to double my payments back out. I thought it was 5. It was going to give me $1 million a year. Well, turns out it's worth 10. I'll get back $2 million a year. Whatever's left after 5 years still out of my estate. No gift tax. So my friend, the estate tax auditor or the gift tax auditor, is not going to be all excited. Well, this situation here that the IRS looked at was, in their eyes, so egregious that it disqualified the GRAT from being able to work. And they just called this thing a big gift and a big hoax. And they relied upon a court case called Atkinson, where the same thing happened with the charitable remainder trust. The people set it up, but they never apparently expected to do anything. They didn't make their payments. They didn't. If it's gonna be a duck, it's gotta quack. Remember that. If it's gotta quack like a duck. I don't know who made the quack like a duck thing up, but it was what we used to always say all the time. If you're gonna be a duck, you gotta quack like the duck. And house train it too, because if it runs around your house and does little poopies, it's really nasty. So you really don't want to have the duck analogy as much as maybe a dog. If it's going to be a dog, it should bark like a dog. It's house trained at least. But anyway, John Porter had a great idea at the Heckerling Institute, and he said, okay, if you're concerned that the IRS is going to disqualify your GRAT, if you're putting 99% non-voting membership interest of a company into the GRAT and saying this is $5 million worth of company, use a formula clause transfer document to say, I am hereby putting in a fraction of the company, the numerator of which is 5 million, and the denominator of which is the value of the company. And if the company's worth 5 million, that's 99%. And if the company's worth 10 million, it's only 50%. That's what's going in the GRAT. So now you should not be disqualifying your GRAT. and they'll come up, the IRS will still fight this, but it is a safer way to fund a grat. So I consider that to be a hot topic. And if you're still awake, we will go to the next hot topic. And the next hot topic is really good reading. The tax court judge that wrote the Levine case should definitely have an entire course on how to read and write a court opinion. Because I don't recall the name of the judge who wrote the opinion, because he or she does not have their name on it. But it is really a well-written opinion. There's not a single sentence that you can't follow. And he's making all sorts of allusions to Victorian era English armor, knights, weaponry, and the only words that you can't understand are the colloquial terms for a chink in the armor. Now, in the Levine case, Mrs. Levine had made a lot of money opening and operating a Penny's store, but it wasn't Penny's department store. It was like a Penny's 5-cent type store. She came out with $5 million in the 1980s. She invested it. She ended up with $20 million in the 90s. She helped her children buy life insurance on their lives. So I don't remember the exact numbers, but she put, say, $20 million into these life insurance policies. And in exchange for this, she had the right, upon termination of the policies, or when the policies matured, which means when the child dies, to get the greater of the money she put in or the cash value of the policy at that time. And that's called an equity split dollar arrangement. So I pay the premium, and all I get back is my money back or the cash value if that's greater. And by the way, the cash value is almost never greater than what you put into the policy if you design it properly. And then every year, she's considered to have made a very small gift to the trust based upon what the cost of term insurance would be, basically. So it's not a lot. It's called equity split dollar. And at a certain point where the child gets old and the term life cost would be high, you convert it to what's called loan regime split dollar. So tell me, if I put a life insurance policy on a healthy 45-year-old, and I have the right to receive back my money when the 45-year-old dies without interest, what is that $20 million worth? It's like worth $8 million or $6 million or $7 million. So the IRS said, no, too good to be true. She died. You can't take such a large discount. And they said, even though we agree, they stipulated that there's a significant discount here because she, under state law, had the right to amend the agreement with the trustee of the life insurance trust, which any two parties in the world to any agreement can amend it. You can't say we cannot amend this agreement, because you could just amend the part that says you cannot amend it. That's the way state law works. So he said yes, under Internal Revenue Code section 2036, A in parens, 2 in parens, if you and someone else have the right to change something and you put it in, then it's taxable in your estate at the whole value. So if the split dollar agreement said we have the right to amend this agreement by mutual consent, then you would have been hoisted upon your sword, dead. But fortunately, in this agreement, the Levine agreement, it said only the life insurance trust can terminate this arrangement. So even though under state law, Both parties together could have terminated it. The court said that based on the Helmholtz case, which is a 1930s US Supreme Court case that I've never read, I hope to read it someday in my spare time, you're okay. Taxpayer was okay. So what's the moral of this story? The moral of this story is if you have a split dollar agreement where you have advanced money to a life insurance trust under the equity regime, it's going to work. But if it has a provision that says that this agreement can be amended by both parties, you need to go and amend or restate and amend that split dollar agreement more than 3 years before the client dies. And so Marty's write-up on the Levine case, I think, is a very good write-up. He does a very good job pointing out many aspects of that. Okay, the next hot topic for those of you who are still awake, especially for estate planners, is the Biden administration's fiscal 2023 revenue proposals and their attempt to exact $2 trillion of taxes from the top 0.1% of net worth individuals and families in the United States. To me, that was the big news. That's a big number. And the way they were going to do it, the way they want to do it, is not overly complicated. They will say, question one, is the net worth of this family $100 million or more? That's question one. If the answer is no, don't worry yet. If the answer is yet, go to line 2. Line 2, does this family have any assets that have gone up in value above their cost that the family has not sold and paid capital gains tax on? If the answer is no, then we'll see you next year. If the answer is yes, then please multiply that capital gains income that is inside the assets that haven't been sold and pay us capital gains taxes on that 1/10 a year over the next 10 years. So you have a situation where a family is worth 100 million and $60 million of their assets are cash and 40 million of the assets cost 10 million. They invested 10 million and it's worth 40 million. They have a $30 million unrecognized capital gain. Multiply $30 million by a capital gains tax rate. Maybe that'll be 20%. 30 million times 20%, $6 million payable, $600,000 a year over the next 10 years. So that is the proposal that struck me as something that will be somewhat difficult to get US senators to not vote for, because there's not that many people to stand up for the 1/10 of 1%. So if the Senate goes a couple of more Democratic seats in the midterms, which anything's possible, that proposal, I think, could possibly see the light of day. Now, if you want to read the whole Green Book, it's not a difficult read. It's well written. And you can click here on page 63 to get it. And the proposal is much like the Build Back America Act, much like the Bernie Sanders Act, but much gentler on the estate tax side of things. The corporate tax would go up to 28%, not effective till January 1st, 2023. The individual rate would go up to 39.6%, not effective until January 1, 2023. But here, number 6, long-term capital gains and qualified dividends presently taxed at 20% would go to 37% to the extent of taxable income exceeding $1 million. And that would be effective upon enactment. And then number 7, we would go Canada. Transfers of appreciated property by gift or death will be treated as if they were sold at the time of the transfer, unless to a spouse or charity. That would also be effective next year. So that would cause a lot of gifting this year if it was to pass. Now, number 8, and this is near and dear to our hearts, valuation discounts would be limited to transfers of active trades or businesses, at least in determining whether a family is worth 100 million or more. So, you have a $10 million home, and which is 3 bedrooms, 2 baths in California, a $10 million home within view of the water over your neighbor's house. And then you have 120 million of stocks and bonds. So you put the 120 million of stocks and bonds into an LLC, and you have 1% voting member interest in the LLC, owned by Uncle Floyd as trustee of a Nevada trust. You have the ability to replace Uncle Floyd as trustee with another trustee, and then you own the 99% non-voting member interest. It's valued at 90 million. It's valued at 85 million. That plus your home in California, you're under 100 million. Well, under Section 8 here, that won't happen. That will not be enough. You'll need to get that done before the billionaire tax kicks in. And when over 100 million is the billionaire tax. So I guess the good news is people with 100 million will be considered to be billionaires, or at least taxed that way. Number 10, grats won't work nearly as well as they do now. They probably won't even be considered by anybody. That would be after the date of enactment. So probably the most important thing that families over $100 million can do today, besides call me without delay, is to set up a grat and use that grat, because it will be grandfathered. How do I know that? Because I said it would be, and that's the historical perspective here. Now, number 11, transfers to grantor trusts would be considered taxable for income tax purposes. Oops. So I've set up this trust. It's out of my estate for estate tax purposes. It's disregarded for income tax purposes. I'm paying the tax on behalf of the trust. My payment of the tax is not a gift. This law passes. I put more in. I pay capital gains tax as if what I put in was sold at the time of the transfer. And for trusts that I establish and fund after the date of enactment, my payment of the income tax is considered to be a gift. Number 13, this was a big surprise. If I sell a $100 million asset or a $100 million note, then under the Internal Revenue Code, as long as I use the applicable federal rate on the note, it's not a gift if the note is worth less than the sale amount. So in other words, I get back a $100 million note, but it's interest payable 2% a year for 25 years, and then in 25 years, I can get my principal. That note is not worth 100 million. It's probably worth 75 million. So now I transfer the note to a trust for my children in exchange for a $75 million demand note. And now I've reduced my estate by 25%, and I haven't made a gift under the gift tax rules. Bzzz. No, not under number 13. Once they pass this, and I think this one is somewhat likely to pass. I don't know how, congressmen and senators can't say, yeah, playing with notes. I mean, just because it was Jerry Hesch's idea doesn't mean that we can't say you can't do it anymore. So taking all these discounted notes, all these notes that you have now, and making the best use of them this year. There's an article I wrote called The Biden Third Step that I'll be glad to send you if you want to see a copy. That would be something worth thinking about. So I will mention here that I think that there is, according to my law clerks, who only work Fridays now because Stetson Law School has classes Monday through Thursday, but not Friday. So I have 6 law clerks on Friday and no law clerks Monday through Thursday. But anyway, there's support for the proposition that you can't tax something that hasn't been sold yet. So we'll have years of challenges to the billionaire tax if it ever gets passed, or quite likely, maybe President Biden doesn't really want the tax to pass or expect it, but he feels like he has to propose it to fulfill his campaign promises. By the way, the other thing that would happen is the hedge fund operators who can now receive income from the funds that they manage, which are taxed as partnerships and this is called carried interest. It's taxed right now at capital gains rates. That would go to ordinary interest rates. So page 78, what do we do? Well, the best thing we can do is the installment sale to a grantor trust. And I've shown this so many times that I think I'll skip it today, other than to say that you can instantly turn $20 million of assets into $14 million of promissory notes and still have pretty good access to the assets. And then the assets grow, you pay the tax on the dividends and interest, and the promissory notes only grow at the interest rate. Now, if you were smart enough to do this about a year ago, the interest rate would only be 1.35%. Now it's over 2%, and it's going nowhere but up. So these long-term notes at what we call the applicable federal rate, you use the semi-annual applicable federal rate with interest paid annually. Don't use the annual applicable federal rate. For some strange reason, you have to use the semi-annual applicable federal rate. If you Google IRS applicable federal rate, it comes right up. There's a long-term rate for over 9 years. Go up to the life expectancy of the client. That's the standard of practice. There's a midterm rate over 3 years up to 9 years, and then there's a short-term rate, which is probably 0.25% right now, of up to 3 years. So get assets out of the client's estate into an irrevocable trust that's disregarded for income tax, get back a note, make the annual payments on the note, and do that to the extent you can. But for your $100 million family, it's not so easy. I mean, if you pack $100 million into this LLC and these notes come back at $70 million, the delta of 30 million is not a gift. But what if the IRS comes and audits the client and says, well, we think the delta between 100 million and 70 million is a gift. And there's at least one tax court case where I think Judge Foley only gave a 14% discount. And then the client says, oh my gosh, that's a $14 million difference, $15 million difference. I'm going to owe gift tax because I've already used my 24 million exemption. So I want to do a large gift, but I don't want to risk the gift tax. Well, okay, we'll put a formula clause in there, and we'll say that if you accidentally made a gift, any excess would go to a charity, but there's still that risk of a gift tax. Very little risk, but nevertheless, your client doesn't want to pay a gift tax. So that's where you go to the grantor retained annuity trust. I'm going to go now to page 175. Okay, page 175. Used to be that I could just type in 175 return, but it's not working. By the way, the Secure Act proposed regulations came out, and we've been analyzing them. We've written 2 Lineberg articles on them. And what I wanted to make sure to mention is that we can use now powers of appointment and trust protectors to resituate irrevocable trusts that receive distributions from IRAs and pensions to fit the rules exactly right. So if the IRA is going to a trust for the benefit of the spouse and the children of a prior marriage, which is pretty common, not as a rollover, but into what we call an accumulation trust to protect the surviving spouse and the children. Under most scenarios, that IRA has to come out within 10 years. But under the new proposed regulations that came out February 24th, 175 pages, what you can do is say, my spouse will be the beneficiary, and one of my siblings, who's no more than 10 years younger than me, will be the secondary beneficiary. And then after that, my children will be beneficiaries. So you would pick your oldest and unhealthiest sibling between you and your spouse. And then the photo is taken at date of death, and the payout comes out over the spouse's life expectancy. And then when the spouse and the sibling have both died, then it's there for the children. Because otherwise, if it's just spouse and children, then it has to come out within 10 years of the death of the plan participant. So, and now you, according to the proposed regulations, you can just put in trust protectors who can say, we'll change this all around, and they can change it all around on or before September 30 of the calendar year following the date of the plan participant. So if you have a large IRA account or accounts going into a trust, go ahead and make sure that there are trust protectors who can play those games, and that they would have the ability to add siblings as beneficiaries of trusts for tax planning purposes, not because they like their siblings, because most people don't like all their siblings, or they like some of their siblings. Okay, let's go to page 213. It's okay to accidentally pay gift tax. If you pay gift tax, you will save estate tax. And most people don't realize that. But the reason is, if you make a gift and you pay gift tax, then the gift tax that you paid is out of your estate for estate tax purposes. So, because when you pay estate tax, you don't get any deduction for the estate tax you pay. But when you pay gift tax, that is in effect deducted from the estate tax. So in my example, somebody with 10 million makes no taxable gift, pays no gift tax, and the family gets 6 million. But instead, they gift 2 million and it's all taxable. They pay $800,000 in gift tax. Now the estate is only 7 million too, and the family gets 6,320,000. Not to mention that they got 20 million early. That's the time value of money. So what is this $120 million family going to do to get under 100 million? Well, they could give it to charity. I'll be glad to set one up and accept it. Or their children will be glad to set up a charity and accept it. Or make a gift and pay the gift tax. Nobody's going to do that. Or do some aggressive planning, knowing that if it doesn't work, you'll pay the gift tax and you will still be better off. And of course, the charitable lead annuity trust, which I'll get to in a little while, I think will be the vehicle of choice for families over 100 million if they are at all charitable, or at least willing to pretend that they are charitable. Okay, I've got a lot of charts here that the advisors can use to show their clients how smart they are. I wanted to go over GRATs. But let's go over the transfer of an active business and how effective the planning can be for this. many advisors are just very comfortable putting stocks and bonds into an LLC and doing a discounted sale. And that's all good and well. But the leverage is much better when you have an income producing business, especially when you have an S corporation. So here we have an S corporation. It gets $10 million a year of income. That's net before taxes. And it's valued at 6 times earnings. One main reason for that is that the owners don't have a non-compete, and they're the ones who run it. And if they ever disappeared, heaven only knows what would happen with the place. So we know that the company's worth 60 million, and 40% of 60 million is 24 million. And if you take another discount for lack of marketability and lack of control, then you have 18 million if you take a 33 1/3% discount. Now the discounts probably should be larger, but you can ask the appraiser to be very conservative. I like 33 1/3 because it helps my numbers stay round. I can go from 60 million to 24 million to 18 million using 33 1/3. All right, so I sell the 40% ownership interest in exchange for an $8 million note bearing interest at 1%. I guess we'll need to percent it 2%, but that's how long ago I set this example up, before I invented the internet. Now, every year, this trust that just bought the 40% is going to get a check for $4 million. It's going to pay $180,000 in interest. Right now, it would be $360,000 in interest. After 5 years, the trust has $20 million, and it still only owes an $18 million note and 40% of the company. And Kelsey, I've got a typo here on page 231. $1.8 million should be 18 million. So what does that look like here? Always draw this for the client so that you can understand it and remember what you did. Here's the S corporation. It has annual income of 10 million. It's worth 60 million. I gave 40% to a trust in exchange for an $18 million note. First, I gave the trust a $2 million seed capital gift so that it has a reasonable net worth. And now the trust will pay me $180,000 a year. Nowadays, if I did this transaction now, it would be $360,000 a year. By the way, I give a tiny part of the S corporation to a special trust for grandchildren that controls if and when there is a liquidation or distribution of the S corporation to avoid the effect of Internal Revenue Code section 2036A12 if I want to be safe from section 2036A12. Anyway, after 5 years, the trust has $20 million minus $1.8 million that it would have paid me. So it's got about 19 million in cash, plus it still owns the stock. So now the trust is worth $25 million on a $2 million gift. After 10 years, the trust is 40 million minus an 18 million gift. So this should be 20 million. If the company now sells after 10 years for 100 million, then the trust is going to get 40 million. The clients get 60 million and they use that to pay their tax. So as you can see, number one, my math is wrong. Sorry, I'll correct it. But number two, the result can be phenomenal. So, can I show you next? I'm going to skip the Qualified Personal Residence Trust because we have the Qualified Personal Residence Trust is something that I think most people understand. They're at page, thank you, Kelsey. Grats are at page 327 to 330. Grats are going to be very important to families over 100 million. So I'll spend 10 minutes here on grats. First, let me answer some questions. Some of you asked some questions. Number one, is the puppet available for bar mitzvahs or weddings? Yes, but not on Saturdays from 11 to noon. He's booked Saturdays from 11 to noon. Number two, can you discuss strategies when using grats to get around the GST ETIP issues? David, fantastic question. I'll make sure to cover that in the next 9 minutes. James, not only is the capital gain not recognized, it isn't even realized. That's right. Okay. And then James, if we have tax on unrealized gains, does the wash sale rule go away and we can harvest realized losses? That's a great question. You know, all the questions that come up on this $100 million tax. What is a family? Is it only a married couple? Should they go ahead and get divorced if they're at 100 million each? They get divorced. Now they're only at 100 million each instead of 200 million. That would be a good reason to get divorced, wouldn't it? Or does it include what's been in trust for the children? Can you take unrealized losses against unrealized gains? We don't have any of that information yet. I don't think they've gotten that far, other than to predict that somehow this will bring in $2 trillion into the Treasury. All right. Mary asked, can you add your older and unhealthy sibling as beneficiary? What prevents them from taking the money? Okay, well, the answer there, Mary, this is for the IRA trust, is yes, you can add your older and unhealthy sibling. They are a beneficiary that the trustee may, but is not required to make a distribution to. So maybe the trustee will give them $100. The trustee has a fiduciary duty to make a distribution, but if the trust says it's in the absolute discretion of the trustee, that fiduciary duty is not going to be very easy to exercise if that older sibling doesn't traumatically need the money. The other thing that's interesting is you can give the spouse a power to appoint the assets to anyone on earth, including a charity, and that won't be considered it to be a beneficiary, even though the spouse has the power of appointment, if you follow these rules. So I hope that the permanent regulations on IRA payments are as generous as the former regulations. Okay, giving me about 7 minutes to talk about grats, which is good because I think I can cover it. GRAT stands for Grantor Retained Annuity Trust. The name is more complicated than what it is. The Grantor Retained Annuity Trust is a trust established by somebody called the grantor, and it is for the benefit of individuals or entities other than the grantor. It can benefit the spouse, so you can have basically a spousal limited access GRAT. So the GRAT document says when the trustee receives assets from the grantor, they will be valued on the day one value. And then the grantor will receive back payments each year based upon a percentage of the day one value. So a 2-year GRAT might say that at the end of year one, I will give you back 49.4208% of the day one value. And at the end of the second year, I will give you back 59.305% of the day one value. And when these numbers were run about 8 years ago, using the IRS actuarial assumptions, this would be a $1,000 gift. So I put $4 million in, and I have the right to receive $1,976,000 of cash or assets at the end of year one, and $2,372,000 of cash or other assets at the end of year two. And then whatever's left in the GRAT belongs to the GRAT. It's out of my estate. It can be used for my spouse's health, education, maintenance, and support. Then my spouse can direct it among my descendants, and it's out of my estate. So what do? I take $6 million worth of assets or a business, put it in an LLC, transfer the 99% non-voting member interest of the LLC to the GRAT. I value the non-voting member interest in the LLC at $4 million. At the end of year one, the GRAT owes me $1,976,832. It may pay me back cash, or it may pay me back LLC interest. At the end of the second year, it owes me $2,372,198. It may pay me cash, it may pay me LLC interest. Whatever's left in that GRAT at the end of year two is out of my estate for federal estate tax purposes. Now the IRS comes in and says, Alan, no way, you valued it at 4, it's worth 6. I say, well, I don't owe you a gift tax on 2. What I have to do is get bigger payments from the GRAT. So instead of $1,976,000 at the end of year one, I will get almost $3 million. At the end of year two, I'll get almost $2 million. I'll get almost $3,600,000, but I don't owe a gift tax. That's the magic of the GRAT. So even if you just put in an S&P portfolio of $4 million in year one, if it has a good 2-year run, if it goes up by 10% in 2 years to $4,400,000, then you get your money back. But if it goes up to $6 million, which sometimes happens, maybe every other time, then you've got a lot of assets in the GRAT. So for the wealthier family, here's the wealthier family here. So you're going to do a dynasty trust transaction. Let's say this client has a $200 million situation, and they want to get this way down. So you say, well, you have $200 million. Let's put $20 million in a dynasty trust, and put your $200 million in an LLC, and value the LLC at $133 million, and sell the non-voting member interest to the dynasty trust for a $133 million note. And then the client says, but wait a minute, what if I get audited and they say that $70 million delta is too much and they want gift tax from me, and then I will cry. So, okay, well, that's too big. Why don't we go 50 million with the installment sale and 150 million into a GRAT? So underneath the GRAT, you have a separate LLC with a separate set of assets, a conservative appraisal, and a very good arrangement. But, and here's another example of a GRAT. You take 10% of a company that makes $300,000 a year. What's that worth? Maybe it's worth $1.5 million, but it's non-voting, so it's only worth $1 million. So you put it in a 10-year GRAT, you get GRAT payments back to the client of $120,000 a year. The GRAT is zeroed out, there's no gift tax. But what actually happens, $300,000 a year goes into the GRAT at the end of 10 years. The GRAT has $2.5 million after making its payments, plus it owns 10% of the company. That's pretty good. The IRS comes in and says, you undervalued the company. Okay, the GRAT owes more money back. The biggest problem with the GRAT is that what passes to the children has to be taxed at their level under what we call the ETIP rules. And the way around the ETIP rule, if you want to be aggressive, is to read Stacy Eastland's Taking the Grat Out of the Grat Hat outline. He has 3 or 4 ways to do this. One way that we've done it at risk, not without risk, is right there at the end of year 1, the company is worth still, that company stock is worth maybe, you valued it at $1 million, maybe it's worth $1.2 million now because a year has gone by. And all these payments are still owed. So what is the Grat worth now? The Grat's worth $300,000. So the Grat sells, the remainder interest of the Grat is sold. When we set up a Grat, for those of you who are advisors, we typically set up the Grat and then a remainder trust that the Grat is payable to. So at the end of year 1, this remainder trust has a remainder interest. It sells its remainder interest for a $200,000 note to a dynasty trust that is GST exempt. The IRS does not like this at all, so please don't tell them about it. But you can read Stacy Eastland's outline. There are other ways to try to get that GST exemption, but quite candidly, you have to tell the client there will be an estate tax on that second generation. So the installment sale is a much better arrangement, but if the client doesn't like gift tax, then the Grat goes well. And then, of course, I did not get to, and I apologize, I did not leave myself time for charitable lead annuity trusts, but the basic concept there is the reverse of a zeroed out Grat. I put my assets into a trust. It pays charity for a term of years, and then everything that's left after the term of years goes to my children, estate tax free. That also also has to be taxed at the children's level when they die. We could get to that maybe next time. Okay, I want to thank you for staying so engaged during this presentation. Probably the reason was you're not at all interested in what I have to say, but you're very interested in what Marty Shinkman has to say. Before I play the video that I recorded with Marty last night and that I really enjoyed, I want to tell you a little bit about Marty. Marty has had an office in New Jersey for many decades. He practices law in New Jersey and in New York. He and his longtime partner, Tom Tietz, are excellent, excellent lawyers. Certainly, if we're doing anything in New York or New Jersey, we are getting help from Marty and Tom. Marty has written over 37 books, over 37, and unlike my books, his books are really good. He writes at least 20 to 25 articles a year, and he also practices law and is a great guy. So if you have any questions for Marty, you can email me and I'll forward them, or we will make sure to send you Marty's email address. So now, by the magic of Kelsey, our master of ceremonies here, I introduce the video with Marty. The discussion.
Okay.
Welcome, Marty Shinkman, to our Saturday at noon. Marty, I have put everyone to sleep. They're all comatose. Half of them are in the bathroom right now, but
you must have been lecturing, Alan.
And I'm sure we have a very big crowd because you're here and you're a big draw. But for people who don't know,
I have a big pencil. That's why I can draw big.
That's right. That's right.
Quick Draw McGraw, remember him?
Yeah.
No one in the audience, they're all too young to know who Quick Draw is.
But for those of us who know who Marty Shinkman is, we're just really, really lucky to have you both as a friend, but in this profession, because you do probably more for our profession. And for the people who are helped by our profession, than anyone that I know or that I can think of. And first of all, you're really, really smart. That's clear. But
if you'd said good looking, you would have gotten a lot more points.
But
can I just interject? Let me interject a comment, because what you said is actually very meaningful to me. When I started in our profession, I was working in the basement of my house. I remember I couldn't afford a copier with a feeder, so I had a copier where I had to stand there and put pages in. It was, I was starting below the bottom. And I remember going to conferences or running into the muckety mucks of the profession and trying to, ask a question or, could I ask you a favor? Could you just give me some guidance on such and such? And I just found a chill. I just didn't find many people willing to lend a hand. And it always bothered me. And I just don't understand that. When you've achieved a certain level of success, play it back. I mean, how hard is it? I get emails from colleagues, young colleagues just asking, like, how do I do this? Or where do I find information on this? Or do you have a thought on this? And I know that the 3 minutes that I spend, could save them days of torture. Like, why wouldn't I do that? So we should all do that. We should all do that. And the other thing that I try to do, and oops, it's American Cancer Society. There's so many great charities and causes out there, and I know you've been like an amazing help to so many, and I try to do it as well. So many charities could use our hand. Even if you're a young, upcoming estate planner, if you can loan a hand to a charity, I mean, it's just it's so easy to have a positive impact. And I just feel the way the world is now, and we're not going to get into that. I mean, any positive vibes any of us can put out there is needed. So please do it, everybody. Okay, back to you.
Well,
I've pontificated.
Give us a good example of what your involvement with the charity has been, because it's a wonderful example.
Well, I speak for a lot of charities. For reasons I'm always thrilled and mystified by. When I speak, they get large crowds. So if me making the effort to write a speech and present it, helps draw people in for a charitable event, so that a good organization with great, doing great things in the world can get more people to know about them, it's my pleasure. When I do webinars that I host, I try for 100%. I don't get quite there, but I try almost every time to feature a different charity. And I've featured, probably dozens of different charities over the years. And the idea is just to help educate our colleagues about who charities are. I remember a statistic, it was a bit old, but I suspect it stayed true. And don't feel insulted as a lawyer, but 92% of planned gifts, 92%, the donor talks to their accountant before making the gift. I felt kind of bad, like, why don't they talk to me, the lawyer, but they talk to the accountant. But the point is that we as advisors can have an incredible influence on helping encourage and guide people to make charitable gifts. I mean, what a wonderful way to give back while you're just doing your job. And I don't feel it's my right to tell anyone who to give to, but to help show them how they can give, or how they can afford to give more, or how they can give and have Uncle Sam contribute to the cause. It's what we all do. It's a great thing.
Very nice. Very nice. Well, as one of the most productive and technically oriented tax lawyers in the country, I'm really interested in the human aspect of estate planning. So and by the way, you have a really nice library. Don't you have a nice video library that laymen can go to understand the law? Is that easy law?
I have two things. There's a consumer-facing website called LawEasy, LAWEASY.com. There's probably about 170 or 80 video clips. Some of the other content I haven't kept quite as current, but there's at least 180 10-minute planning video clips. If you hear from anybody that there's topics they want, I'm going to volunteer to do as many 10-minute video clips on topics people want to hear about with you together, and post there. And you can post them to your website too. So that may be helpful. And hopefully as I go on in the future, I will add more to that, because I think, again, it's just part of the giving back. I just want to create resources so consumers can understand some of the complex stuff that we do. My law firm website, it's really a legal education site almost, is called Shankman Law. And the webinar tab there has probably 150 webinars. Those are mostly, not all, but mostly a little more technical, designed for professional advisors. But a lot of our clients are very smart. I find a lot of clients listen to it, and if they understand half of it, they're way ahead of the curve when they go talk to their advisors, so it helps them. And there's probably 300-400 articles on the blog page there. So there's a lot of material there too, all free. Help yourself. Just don't take legal action without talking to your advisors. Now they know I'm a real lawyer. I put a caveat on it.
Now, Marty, I know that we kind of intended for this program to go about 30, 35 minutes, but if you want, we could go part 1 and part 2. So because I think you should take your time. Don't worry about time. Our audience will wait as long, we'll be here as long as you are. So I'm just really, interested in you taking your time and meandering through what I know is a really important program here.
Just to emphasize what you said, and kudos seriously to you for recognizing that the human aspects of planning is so important. Too often when people go to anyone in any of the allied professions, it's certainly not a criticism of lawyers, anyone in the allied professions, we all tend to focus on technical tax, investment allocations, tax nuances, et cetera, et cetera, et cetera. And in the end of the day, if we neglect the humans, the people, the souls that are involved, we're not really getting people where they want to be. If you're religious and you want religious considerations addressed because that's just important to you, and your plan violates your fundamental religious precepts, I mean, that's terrible. If you have a child that's LGBTQ and you're not taking the steps necessary to protect the child, what does it matter that you get an extra few dollars potentially going to the child if either it doesn't go or causes harm? There's just so many different things. I know you do an awful lot, and I know you do so much of it. I'm going to ask you a personal question when we're off the air about asset protection. I don't want to delve deeply into it, but I just find, and I don't know if you experience the same thing, that too many clients get tax focused and they forget about asset protection. Or people that are worth less than $1 gazillion feel, oh, that's for the wealthy people, I don't need to worry. But no, you actually need to worry more, because if you lose $1 million in a lawsuit, that may be the difference of your kids going to college or not. And asset protection could be taken down to very modest levels by just getting proper insurance and having that rental property in an LLC. So there's just so many different facets to the non-tax, non-legal aspects of planning that is what makes it robust. It makes it tailored to the individual. And it just works. We're not going to get into financial planning, but I probably have, wild guess, 4 to 5, maybe 6 clients a year that come to me. And after about 15, 20 minutes of looking at their balance sheet and hearing them talk, I say, listen, I can do whatever trust or whatever they came to me for. But if you don't talk to a financial advisor and your accountant and get a budget and get on track, you're going to be eating cat food when you're like 80. You can't live like this. And I'd say half the people are, when they finally get the message, are incredibly thankful. Half get angry at me because they came to me because they felt they were so wealthy they needed this fancy trust that they heard about on the golf course, and get upset that I'm suggesting that they may need to take more remedial measures. But boy, what good does a fancy estate plan do if you're going to run out of money? So, and I've just kind of rambled, but the point of the rambling was to illustrate that there's a myriad of different facets of the human aspects of planning, of the non-tax, non-legal, non-asset allocation aspects, the non-technical, that stuff that we all, whether you're an accountant, attorney, wealth advisor, insurance consultant, take a little bit of a step beyond the core of what we all do. There's so much important stuff. And I think the key message, and hopefully the rambling will help that, is clients need to be proactive and assertive. If a client comes into my office or your office and they don't say, you know, my spouse has got some drug addiction issues, right? You know, it's really hard for wealthy people in particular because these are issues that only affect non-wealthy people. It's not true, right? You should see the statistics. I just did an article on mental health and lawyers. The percentage of lawyers that have drinking and drug abuse problems is terrifying, terrifying. So it affects everybody. And if a client can't feel comfortable telling us that, and I'm sure over the years you've seen a lot of different types of addictive behavior, from drugs to alcohol to theft to gambling, et cetera, et cetera, et cetera. If a client can't feel safe telling us that, we can't take the steps to help them.
Yeah, and certainly we can learn to be better listeners and people that clients can feel comfortable talking to.
Clients have to feel comfortable talking. And clients, the biggest mistake I find is when a client calls me up and says, I need a Cupid, I need a GRAT, I need a defective grantor idjit or something like that, because they heard from all their friends that they have it or they read something online. You got to start as a client, not with the answer, right? That's like going to the doctor and like the ad on TV, because it's a drug company trying to get you to buy their pill. Go to your doctor and ask for the purple pill. But the same thing is when they come to an attorney and say, I need a GRAT. Well, how do you know you need a GRAT? I don't even know what you need done. How about talk to me and tell me who you are? I mean, yeah, I need to see a balance sheet and some financial data and some family data, however you define the term family, but talk to me. I remember once a very well-respected wealth advisor was referring a client to me and scheduled a call before the client came in, and she wanted to create a agenda for the meeting. And I listened to her and I said, with all due respect, I don't want to create an agenda. I don't want an agenda. I want the client to come and I want to listen through these. I want to listen to them talk. I want to, and not only do I want to listen to them talk, I want to hear what they don't talk about. I don't want to have an agenda, because if you have an agenda, what's the tendency with the agenda? After you do item 1, you go to item 2, you go to item 3. I want the client to ramble, because in the rambling, and even in the silence between the rambling, you get a sense of things that are important or scary to them. Then we can really help. I'll give you a perfect example, and I'll share something personal. I know you know, but the audience doesn't know. My wife was diagnosed over 15 years ago with multiple sclerosis. Changed everything about our lives. Changed our lives financially, changed her career, ended her career, changed how we travel. It actually put me on a wonderful path, because we squeezed lemonade out of the lemon, where we have a charity and spend 2 months a year on the road, traveling around the country, raising money and awareness for the American Brain Foundation and the American Cancer Society and other wonderful charities, and have a great time doing good. Can't beat it. It's a business deduction, but don't record that part. But I've had clients that have had comparable significant health issues, and they won't tell me. How can I help them? I mean, I can do a little bit, but if I don't know what's going on, what can we really do? If I don't know that you have a special needs child or grandchild, how can I help you address it? I have a special needs grandchild. I understand the pain, but if you don't share that with me, what can I do? I think that clients in part are sometimes uncomfortable sharing because they don't know that we can really help them. And I don't think it's an exaggeration, but for example, with health issues, next to the medical professionals, when I say we, I mean the entire advisory team, accountant, attorney, financial advisor, wealth advisor, trust officer, we can do more to help protect clients with health issues and safeguard them, not just financially, but from a myriad of different things, than maybe anybody else in their lives other than the doctors. And sometimes what we do is even as important, depending on the condition and the situation. But I don't think a lot of clients realize that, so they're hesitant. And I think, and it's shame on us as a culture, because I think it's a cultural thing. We make people feel inadequate or uncomfortable sharing these things, and they shouldn't be. They shouldn't be.
Yeah, you're very right. One of my early mentors, a CPA who's now passed away named Marty Schweitzer, used to have me over for a client meeting. And it would go 2.5, 3.5 hours. He would root out in such a friendly, lovely way their business issues, their tax issues, and the personal issues would come out. And he would just keep talking and letting them talk and just keep talking and letting them talk. And they would resolve their personal issues just because they had someone to talk to, which is, you can't do that very easily with a psychiatrist when it's over in 59 minutes and you
40,
don't have a
isn't
meeting
it?
till the 40 and you don't
Yeah.
have another meeting till another. And so often they would remark to him, Marty, I've been in therapy for years and I just never got this far.
Can I add something else that's very important? I never met Marty. I don't know Marty, but Marty had to be a special guy, because not everybody has the antenna or the heart. You need both to do what you just described. But what you just described is what every client should want from their planning. And what you just described is what I would aspire to as an attorney to be able to do for clients. And it's hard. And some clients just don't want to hear what they need to hear. And sometimes when I know there's bad news, like somebody's just out spending their money like crazy, or someone's got a business succession plan that's just never going to work, I will often preface it by saying, listen, I feel there's something that you need to hear, but I don't think you want to hear it. Is it okay if I say it? And I think as an advisor, because I believe you have advisors and, real people on the call. I think as an advisor, if you ask permission to say something that you think is going to be uncomfortable, you shouldn't feel bad saying it, because you've just been given permission to say it. And I'll give you an example too. And this is really for the advisors, and the flip side of it for the client, real people. When I lecture around the country, I'm planning for clients with chronic illness. One of the things that I encourage advisors to do is to ask clients, tell me about your health challenge. Tell me how it affects your life now and may in the future, so I can see how I can help you. Now, if you're doing that and coming from a genuine place, all you're trying to do is help the client, and you're trying to help them really in ways they need. If somebody takes offense to you as an attorney, an accountant, a trust officer, saying from the right place, from a good place, from a caring place, tell me about your health challenges so I can help you. If somebody gets offended about that, you haven't done anything wrong. That's their problem. Don't let it be your problem. You've done the right thing. And I have found over the years, very, very few people, when you do it like that and you come from the right place and you open up a little about yourself so they know you're a real person and a human being and that you have fragility too, I rarely see people get offended. It may be hard for them, but I rarely see people get offended. I have, but it's not that often.
Marty, how is it different in these video calls that we're doing nowadays instead of in person? Because in person, honestly, was easier to establish that rapport.
So, a very interesting question. I would love to see somebody do an analysis where they actually interview 100 clients, meaningful number, maybe 1,000, and interview clients that, let's say half of them met with their advisors, attorney, account, financial planner, in person, and half met only through the web, and to see if there's a disconnect that's in greater proportion on the web versus in person. I can tell you that because of my wife's health issues and our traveling, we usually put about 10,000 miles a summer on the summer and spring on the RV, which is a lot. So we've been gone, other than COVID, 2 months a year. I've been working on the road and remotely long before COVID and long before people even heard of Zoom, before Zoom existed. Can you imagine? So I feel comfortable with it. I had always believed until COVID hit that even though I was doing so much remote work and calls and web meetings, I had always believed that it was better in person. But honestly, I'm not finding that to be an issue. I'd love to see a study to see if I'm wrong, but I'm not finding it to be an issue. And let me give you a contrary thought to what, the intuitive thing is you can read somebody better when they're in front of you, right? But on the other hand, when you're speaking to a client and they're in the comfort of their own home, sitting in their comfortable chair with their, favorite coffee mug, they may be more comfortable sharing than when they're in a law office. And let me jump in and give you another comment too. You're different because you're to a great degree, your firm is kind of an estate business planning boutique. So you're a warmer and you're just too fuzzy of a guy. But if you go into a lot of law firms and accounting firms, but let's use just law firms as an example, it illustrates the point. And you know exactly, I think, where I'm going, what I'm going to say. Many of the law firms, perhaps most, are um, uh, driven or focused on litigation or corporate because those tend to be the bigger dollar items. And what happens when you walk into a conference room in a firm that's corporate or litigation focused, the conference rooms are usually really big, really harsh, and really sterile feeling. That's not the environment to get somebody comfortable to talk. My office is decorated to feel like somebody's dining room. I actually have a conference room table that looks like a dining room table. I have upholstered chairs that look like what would be in somebody's dining room. I have artwork on the wall. I don't have anything made out of chrome and glass and metal to intimidate you. It's not all black to intimidate you. It's soft tones of green and beige and brown. It's comfortable. So, when you talk about in-person meetings, I'd like to know who's doing the meeting. I'd like to know what kind of environment the office is. I think you need to sort of, address people being comfortable in their home. When you're talking about really tough issues that, your child struggling with, their sexual identity, with a child, a spouse, a loved one, however you define it, struggling with drug addiction issues, and you don't want to even acknowledge that they have it to yourself, yet alone to a lawyer. I mean, these are hard conversations. Telling somebody, listen, I know you enjoy going on 3-4 cruises a year for 40 grand a pop because you like the penthouse, but you're going to run out of money just on simple math. I always do if I told you about the 30-second Marty Schenkman estate financial plan.
Yes, and please tell the audience.
So I don't want to do a financial analysis. I probably could. Alan probably does. But I'd rather send you back to your financial advisor, your wealth advisor, your accountant to do it. It's just not what I do best, and I don't want to do it. But what I do for a lot of clients, especially when it becomes obvious just looking at their balance sheet, they got an issue, is I'll take and add up all the financial resources on their balance sheet. Because a lot of the people that we're talking to are retired and they're living on their financial resources. I leave out the houses, and sometimes there's many of them, and the boats and the big boy toys, big girl toys, and just add up the financial resources. I used to multiply it by 4%, but that's probably a little pushy now. Maybe better at 3.5%. And if they have $10 million invested, I may say, hey, can you guys live on 350 grand a year? And if the first reaction is one of the couple, if it's a couple, laughing, if they're laughing, is that the first reaction? They got a problem. And that happens. It happens. And when I say, listen, you're not going to make it. You need to do a budget. You need to have a financial advisor do Monte Carlo simulation and project out, unless there's health issues in your family. I think at this stage, Alan, what do you say, age 95 at minimum, if not 100? I mean, I think you have to go that far. When I see financial advisors, do something to like age 82, I know they're trying to make the client feel good. It's just not reasonable. You got to go out, unless there's a really significant known health issue, to 95 or 100 And honestly, I'm starting to see people go beyond 100 to like 110. But at least go to 95 or 100. And you want to have, I would think, 60, 70% minimum likelihood under all the different scenarios of not running out of money before age 95 or 100. And if you're below that, you got to change things. And if you're at 70% likelihood based on this analysis of like 10,000 random number simulations of investment performance and so on and so forth, you better redo the numbers every year and try to keep pushing it back up, back up a little, because if you start to get below that, you're going to start to worry. You know, a 30% chance potential, and it's not quite probability, I don't know if that's the right term to use, but you know, if you have 30% likelihood of running out of money before you die, that's kind of scary. I don't think I'd love that. Did I ever tell you my my sailboat example? The financial planning? Oh, I've hidden things from you. So financial planning is like a sailboat. Did you know that, Alan? Have you ever sailed a boat? You ever done a sailboat? Yeah. What happens when you sail into the wind? You don't go anywhere. The sail flaps a little. You tack back and forth. And that's what financial planning's got to be. You can't live on it's like living on a diet. You know, you have X calories a day. Leave me alone. You know, can't do that. But if you know, I actually had something that I celebrated with my wife last night, and I dug out a good bottle of wine, and my darling wife did something devious and found a box of like crazy good frozen cookies that we took out. Now, mind you, I've been on a ketogenic diet for 3 years. I can't remember the last time I had a piece of cake or a cookie. We went nuts. It was good. But that's okay, right? Because now back the other direction. Financial planning is the same thing. You have a kid's wedding, you go on a big trip, that's fine. You can't torture yourself. But if you go off this direction, next time you got to go off more that way to balance it out. But when you look at the gross overall numbers, if you don't have a good likelihood of surviving financially past age 95 or 100, you got to address it. And the problem becomes if you get worse and worse and worse and you don't address it, the adjustments become greater and greater. So if at age 65 when you retire, you don't look to quite be on track and you tighten your belt loop one notch, you're not going to be happy. But if you do nothing in 10 years, you may have to tighten 3 notches. And I've heard it said, I don't remember who said it, but it's a very insightful comment. There are very few things in life harder than reducing your lifestyle expenses. It's very hard to do.
Absolutely. If you
so
can,
everything we've been talking about, to me, is part of the human, non-legal, non-tax aspects of planning. And not for everybody, but I would say for the majority of people, this is the heart and the foundation of planning. And unless you understand this, the fanciest trust, the most complex, note sale transaction, the most esoteric asset allocation with, an allocation now to, Bitcoin and private equity, whatever it is you're doing, if you don't start with this stuff, the human stuff, the addiction issues, the personal issues, the religious issues, lifestyle issues, financial issues, if you don't build the foundation, the rest can never be great. I know this was kind of vague, but for people that haven't thought about it, I think it's very helpful. I wish all my clients would listen to something like this before they come in, so they would know to feel comfortable talking, so they know that the more they share, the more I can help them.
So we hope that everybody has a fantastic Easter, and we'll see you the week after Easter. If you have any questions, please let us know, and have a fantastic weekend.
Absolutely.